Is the Nasdaq forming a double top? Why valuation matters again. The setup 2 days ago, I discussed the possibility of a valuation pullback in Nvidia. Since then, we have seen increased volatility across the broader market. But this is not just about one stock. The bigger question is whether the Nasdaq is forming a structural top and whether the conditions that drove the last leg of this rally are beginning to fade. 1. The technical picture. The Nasdaq has been consolidating near its highs for several months. From a technical perspective, the structure increasingly resembles a potential double top formation. This pattern emerges when a market tests a prior high, fails to break meaningfully above it, and begins to lose the momentum that previously carried it higher. It is important to be precise about what this means. A double top does not guarantee a crash. It does not predict a collapse in earnings or a sudden reversal in economic conditions. What it does is increase the probability of a correction. It signals that buyers are becoming less aggressive at elevated levels and that the conviction required to push prices into new territory is weakening. When markets test highs repeatedly without strong earnings acceleration to justify the move, momentum can fade, and fading momentum in an extended market creates structural fragility. 2. The valuation problem. Beyond the technical picture, there is a more fundamental issue: valuations across U.S. equities are elevated, and price expansion has significantly outpaced earnings expansion. That is the core of the problem. Markets can sustain high valuations under one specific condition: when earnings growth is accelerating fast enough to justify the premium being paid. When investors believe that future profits will be substantially larger than today's, they are willing to pay more for each dollar of current earnings. That willingness is what supports elevated multiples. But when profit growth begins to stabilize, when earnings upgrades slow down, when the rate of improvement in corporate fundamentals starts to plateau, the justification for paying a premium begins to erode. Prices can continue to rise for a time on momentum alone, but the gap between price and underlying value becomes increasingly difficult to sustain. At some point, valuation compression becomes not just possible, but likely. The market does not need bad news to correct; it only needs the absence of good news that is good enough to justify current prices. 3. The combination of pressures. We are currently seeing a specific combination of conditions that historically creates market fragility. Multiple months of price consolidation near highs, a slowdown in the pace of earnings upgrades, increasing pressure on capital expenditure as companies face higher costs and more uncertain demand outlooks, and a broader environment in which interest rates have remained elevated longer than many market participants initially expected. Each of these factors alone would be manageable. The concern is their combination. When markets are priced for perfection, when valuations assume that everything will go right, the tolerance for disappointment becomes very low. Any data point that falls short of elevated expectations, any earnings miss, any guidance that signals caution rather than acceleration, can trigger a rapid adjustment in prices. Not because the fundamental story has changed dramatically, but because the margin for error was already thin. This is what fragility looks like in financial markets. It is not the presence of obvious danger. It is the absence of cushion. 4. What a reset could look like. If a technical breakdown were to occur from the current consolidation zone, a retracement toward the 20,000 level on the Nasdaq would not be an unreasonable outcome to consider. That would represent a meaningful pullback from current levels, but it is important to frame it correctly. This would not necessarily represent a collapse in the economy or a fundamental break in the long-term growth story of the technology sector. It would represent something more specific and more manageable: a valuation normalization, a reset of the multiple that investors are willing to pay, bringing prices back into closer alignment with underlying earnings realities. Resets of this kind are a normal feature of market cycles. They are uncomfortable when they happen, and they tend to feel more significant in the moment than they appear in retrospect. But they serve an important function: they clear excess, reduce fragility, and create the conditions for the next phase of sustainable growth. 5. Phase recognition, not panic. The key concept here is not fear. It is phase recognition. Every market cycle has phases, and the transition between phases is rarely announced clearly in advance. The conditions that define the current phase: elevated valuations, slowing earnings upgrades, rising capital expenditure pressure, are the same conditions that have historically preceded periods of multiple contraction. When capital expenditure slows and earnings do not re-accelerate to absorb the cost, margins come under pressure. When margins compress, earnings growth disappoints. When earnings growth disappoints in a market priced for perfection, multiples contract. That is the mechanical logic of how cycles reset. Recognizing which phase you are in does not require predicting the future with certainty. It requires reading the available evidence honestly and adjusting your framework accordingly. It means distinguishing between what the market is currently pricing and what the underlying fundamentals can reasonably support. And it means understanding that the risk in any given environment is not simply the risk of being wrong, it is the asymmetry between what you stand to gain if you are right and what you stand to lose if you are not. Closing thought: this is not a prediction of panic. It is a discussion of structure. When valuations extend meaningfully beyond what earnings growth can justify, markets become vulnerable to adjustment. That vulnerability does not mean a crash is imminent or that the long-term direction of the market has changed. It means the risk-reward balance has shifted, and that understanding the nature of that shift is more valuable than simply chasing the momentum of recent highs. Markets reward those who understand the phase they are in. The current phase is one that calls for careful attention to valuation, disciplined thinking about risk, and a clear-eyed recognition that extended prices require exceptional fundamentals to sustain themselves. Whether those fundamentals materialize or disappoint will determine what comes next. Understanding risk is always more important than chasing highs.